Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So yesterday we did a video on two different oil companies or energy companies, and some of you then commented and said in the Discord and also actual comments on the actual video, and you've asked me if I could look at a couple of other companies, and that's what we're going to do today. So I'm just gonna do a quick overview of these companies. And again, if you are really interested, make sure you are doing proper research before you invest in any of these companies. As always, this is just to kind of give you some ideas and for entertainment, okay? And then of course you're gonna have to do your own research. If you're looking at the portfolio and thinking, what on earth has happened, why is there a massive drop just to today, I've sold something, okay? I've sold one of the stock that I own. I will share that with you guys as soon as I can, inshallah. But yeah, I've sold about £1,800 worth of stock, so inshallah I'll let you know exactly why I sold that company and what I'm going to do with that money. So the overall portfolio is closer to at least £90,000 right now. It's not this one here, okay? So that is out of the way. Let's now look at the two companies that we're going to talk about in today's video. But as always, I've always asked you guys to do this if you can. Of course, join us on the Patreon account where you get access to all of these things. You get access to the Discord where of course a lot of brothers are sharing very good practices, genuinely like talking about stocks and what they buy and why they're buying and so on. And that's really healthy, and that's what I wanted to build. I want to build up basically a Discord where we can have thousands of people sharing good ideas, good practices. Sometimes I find some really useful information, and I'm sure hopefully they'll find some useful information helping each other. So that's the end goal anyway for the Discord. So inshallah, if you can join us, that would be absolutely amazing, and it definitely supports the channel. But the most important thing for me is that you actually like the video, subscribe to the channel. If you can't do that, that will be very important to me. Right, so the first company we're going to talk about today is EOG Resources. This is one of the companies I mentioned very briefly yesterday. I actually really like this company from basically financial perspective and in terms of dividend side of things. Again, it's very similar to the two companies that we looked at yesterday, okay, in terms of what they do. So basically explores for and develops, produces and markets crude oil and natural gas liquids. So it's very similar to the two other companies that we talked about. I'll give you more information on this company of just the overview kind of thing, and then of course, like I said earlier, please do your own research. So as you can see here, for the 1 year it's actually down about 4%, and for year to date it's actually up just 2%. So it has not contributed to the overall markets, because if you know, the overall S&P 500 right now is up about 25% or so, and it's going up by the day, okay? Right. So a couple of things. First, financials. We're going to look at the financials. We'll look at the income statement. The income statement is where you can find the revenue and so on for those who are new. So since 2013, as you can see here, if I just click this graph here, you can see since 2013 it's actually been increasing, but then 2016 it has a bit of a decline. This is why I call a cyclical business, because some years they do really well, some years they don't. So that's why you buy. If you buy in oil companies, you're not buying just for the price appreciation, you're mainly buying for the income, the dividends. And I think that's really people need to understand that. These companies, of course, in 2022, that was an outlier. That was an amazing year. They had an amazing year in 2022. All the other companies, especially tech, were down, 20%. But these companies were going absolutely amazing because oil prices went to this roof. So these are very cyclical business, so you have to be mindful, okay? Some years you're going to do well, like 2022, and some years you're not going to do that well. So from 2013, as you can see here, is $14 billion to 16, then to 8, then to 7, then to 11 billion, 17 billion in 2018, 2019, 16, almost 17 billion, and then 2020 is actually went down to 19, almost about $10 billion because of COVID and what was happening with the oil prices at that point. But 2021 it bounced back to about 19.6 billion US dollars, and then in 2022 that's when it went crazy and it went all the way to 29.5 billion US dollars, and right now we're looking at about 23, so it's a little bit of decline. So that's expected from this type of companies, okay? And when we look at the net income as well, it's more or less exactly the same. So from 2 billion to 2.9, and then there was a basically negative 4.5 billion 1 billion negative again, and basically, as you can see here, is very cyclical. So in 2022, basically we're looking at about 7.7 billion US dollars, and then 7.8 expected for this basically trailing 12 months. So yeah, so that's to kind of give you a little bit of information on that side. Let's have a look at the earnings for this company. So if we look at the earnings estimates, we're using Seeking Alpha, by the way, and I'm sure some of you don't have any subscriptions to it, but you just post the video if you want to really see the whole thing. So EPS estimates for the next couple of years, as you can see here, in 2023 there has been a decline that was expected. 2024 they're expecting to be bouncing back about 10%, almost 11%. 2025 again a decline of 2%, and then again decline of 2%, and then again decline of 7%. So again, normally I focus on the ones that have a first three, because that's the ones that have a higher numbers of analysts looking at it. Okay, so yeah, that's the EPS. And revenue just for the next 3 years, as you can see here, a decline, and then a bounce back, and then a decline, and again 1.6% up again in 2025. And now we're going to look at Simply Safe dividend. So as you can see here, 2.5 billion US market cap wise, and dividends is actually 2.9, almost 3%, and is very safe, 82% right now, which is quite nice to see. In terms of payout ratio, we're looking at about 20. Let me just zoom in. As you can see here, it's about 28% payout ratio, which is absolutely fine. And they have basically increased that dividend for 31 years without reduction. So we'll see that in a second. 10%, latest increase was 10. And this is one of the reasons I actually like this company, because what I'm trying to do is don't buy just companies that are just paying dividends. I want to have companies that are increasing their dividend, because I'm not really interested in the income right now. I'm interested in this income maybe in 10, 15, 20 years from now. And I want these companies to continue paying and increasing that dividend for the next 10 to 20 years. So if they're increasing this, is for the last 20 years, this company has given out basically 24%. That's more than you will ever get from your employer. Okay, your employer will never pay you that much, give you that much increase every single year for basically on your investment or whatever it is, right? So 10%, 36% in the last 5 years, and 24% in the last 20 years. And as you can see, from 2017 onwards, it has gone up quite a bit, which is quite nice to see. And they have been increasing this dividend for the last 5 years. So the last 5 years is when they really started increasing that, but they have been paying this dividend for 31 years. You get about $3.64 for every share of this company that you own. These are the months they pay: April, June, October, and January, and then so on. Okay, now a couple of more things. In terms of our valuations, we said before, the 5-year average, if the current dividend is basically lower than the 5-year average, then that it might be fairly valued at the moment. And that's probably why they said it may be undervalued at the moment, because the 5-year average is 2.5, current out basically is 2.9. So there's not much of a difference, kind of flat there. So it might be undervalued at the moment. And then looking at the current PE, the 5-year average was 10.8. Right now it's about 9.5. So it looks like it's kind of basically undervalued at the moment. The energy sector is about 11.8, and the company is trading about 9.5. So it's slightly cheaper. Now a couple of more things. Free cash flow per share, payout ratio, if I can speak, it's about 34 right now, which is absolutely fine. So below 40 is what we're looking for. So about so that's basically absolutely fine in that. Okay, let me a couple of more things. Free cash flow per share is actually looks like it's growing. It's heading in the right direction, which is nice to see. Sales growth, okay, as you can see, is very similar to the other two companies that we looked at. A couple of years up, couple of years down. But in terms of numbers side of things, so these are the percentage in terms of sales numbers. As you can see here, it has increased in 2022, but it has come down now. So right now we're looking about in the last 12 months, we're looking at about 23.7 US dollars moving forward. Return on equity 31%. In terms of return on invested capital 27%, which is absolutely huge, because Morningstar Simply Safe Dividend is actually looking for about 10% for return on equity, and 8% on return on it, basically above basically 8%. So 27% and 8%. 31% is absolutely amazing. Operating margins of 42%, free cash flow of 24%, and then net debt to EBITDA is actually right now almost flat. So we're looking for zero. So basically, if you look at it, is zero almost. Wow, below 0 point. That's interesting. So there you have it. That's the first part. Then now let's have a look at the valuation side of it. So is it actually a buy? According to Morningstar, it's actually fairly valued at the moment. $132 per share is what they basically said it should be, and right now it's trading 124, so it's slightly lower than where they think it should be. It has a narrow economic moat, and I'm going to just quickly show you in the last 10 years how this company has performed. Okay, so the last 10 years this company has actually given us about 6% total return, including dividends and everything else. Now if we look at simply Wall Street, they're saying it's about 24% discount right now. They expect the price to be $164, and right now it's about $124. So it's just not bad. And the future growth is also they're expecting more or less similar thing. So it's a negative 3%. Same thing that we see here. This year they're expecting about 10% growth, and then after that it's almost a flat basically for the next 5 years. One more thing, and that's tip rank saying it's 150 and 20%, 21% right now upside from where it is. It's a moderate buy. It's about 13 buys, 7 holds, and no sales at the moment. And finally, looking at Seeking Alpha, as you can see, it's a buy, and Quant is actually saying is hold. Their buy price right now is about 16% upside from where we are now, which is $144. Right, the second company that we're looking at, Canadian Natural Resources Limited, which is very similar to the two companies that we have already spoken about. As we speak right now, the year, basically since the beginning of the year to date, basically it's up 27%. So it's done really well, and for the 1 year it's about 17%. So overall it's done actually really good. So in terms of earnings, in fact, let's go to financials first. We're looking at the revenue side of things. $15 billion to right now $26 billion. It has been increasing quite a bit. In 2020 it's actually done about $31 billion, and it is, of course, just like all the other companies, it has a little bit declined in the last basically 12 months. When we look at the net income, so more or less the same. So again, $2 billion to $3 billion, and there's a decline again, bounce back, and right now we're looking about $5 billion of net income, which is basically similar to what we've looked at already. Now looking at the simply what the safe dividend, as you can see here, is $72 billion dollars in terms of market cap. 4.3 billion dividend yield. So the dividend yield is over just 4%, which is quite nice to see. Oil companies normally have a higher dividend yield anyway. 48% in terms of the payout ratio, not bad. And they have increased this. In the latest increase was 11%, which is quite nice. 23%. These two actually are better in terms of dividend wise. They're actually better than the other two that we looked at yesterday. So they're growing it basically faster, if you like. Although the other two are different dividend aristocrats and so on, but these are actually doing really well. By the way, the difference is the dividend aristocrats, they have to be in the S&P 500, and of course have to increase that dividend for 25 years in a row. Kings have to also be in the S&P 500, and they have to also increase it for 50 years. So 23% for the last 5 years and 22% in the last 20 years, which is quite nice. And again, you can see that basically that growth is absolutely amazing for the last couple of years. Like I said already, they have increased this dividend for 21 years and they haven't reduced it. So for 21 years, they have been paying it and they have not reduced it, which is quite nice. $2.89 is what you will get. Remember, this is Canadian, so again, when it comes to taxes and all of that stuff, you have to do your own research. I haven't looked into that yet. And these are the months that they pay. A couple of more things we're going to look at right now in terms of valuation. It seems reasonably valued according to this. 4.4 is the average and 4.3 is where we are. 9.9 is the average, and 11% is basically 11 PE is where we are now, and the other sectors are also more or less the same. Now, free cash flow payout ratio of 55%, below 40 is what we're looking for, so it's slightly higher than what we want it to be. free cash flow per share actually has declined since 2022, which is expected because of what's been happening. And sales growth is exactly the same like what we've seen before. Total sales though has actually 2022 was absolutely amazing year. 2023 is of course a bit of a decline, not too much if you think about, and they look like they are buying back their own shares as well. Okay, return on equity 18%, return on invested capital 14%, operating margins 24%, free cash flow 19%, and net income to EBITDA is actually net debt to EBITDA is 0.84, and below 1.5 is our preference for oil companies. Now, a couple of more things in terms of valuations. Let's go to simply Wall Street. 40% almost upside from where we are now. This is Canadian US dollars, sorry, not Canadian US dollars, Canadian dollars. Okay, 144 Canadian dollars, and right now it's about 87 right now. In terms of growth side of things, oh no, one more thing. And tip rank is actually saying is a moderate buy, 6 buys, 5 holds, and 73 US dollars is basically where they think the price should be. That's 11% from where we are now. In terms of growth, expected to grow about 11% this year, and then next year they're expecting it's basically almost flat for next year. Morningstar does not cover this because they do have it, but there's not a lot of analysts looking at it, so they don't even have a price. So I was just trying to find the valuations for this company, but there seems to be nothing at all right now, so maybe they don't really cover it because it's Canadian, whatever. So there you have it. That's the ratings for one more, actually, sorry. A strong buy from Seeking and Alpha Analyst, and Wall Street is just a buy. So if we look at Wall Street, you will see it's about 10% upside from where we are, which is similar to what basically we've seen with TipRank. So overall, it seems really a good company. I mean, overall, like I've said to you guys before, it's similar to the two other companies that we looked at yesterday. There's a decline this year, there's bounce back next year, and then the year after, this one seems actually it's doing better, and then the year after more or less the same in terms of decline wise. So 27 billion US dollars, 27 again, so more or less flat where it is right now. And like I said, a lot of these companies, you're buying it because of the dividends. Okay, price appreciation, maybe you'll get it a little bit, but they are very, very cyclical. This is one of the reasons I always say to you guys, I own Rio Tinto because of course its commodities, because of the iron ore prices. If it goes up, it goes up with it. If it goes down, it goes down with it. So for me, it's the income, and if I can get price appreciation in this situation, I'm a 15% up. If you had oil companies the last couple of years, you made a killing, trust me. So yeah, there you have it. Inshallah, hopefully I'll do a couple of more videos and on some of the suggestions that you made. If you have any more suggestions, let me know, inshallah, in the next few days. I'm off, so inshallah I'll do as many as I possibly can. Again, it was really appreciate all your support, and if you can join us on the Patreon account, that would be absolutely amazing. If not, just like the video, subscribe to the channel. Let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.